Gold and silver are not easing lower. They are being shoved off a cliff. Right now, as this script is being delivered, gold is slicing through major levels, silver is getting hammered, and every new refresh looks worse than the last one. This is not a calm pullback. This is not routine profit-taking. This is a liquidation event unfolding in real time, and the part most people still do not understand is that the price collapse is only half the story. The more dangerous half is what is happening behind the screen, inside the exchanges, inside the margin system, and inside the vaults. Because this is not just about metals falling. This is about pressure being applied so hard that long positions are being broken on purpose before March delivery forces the market to reveal what is actually there and what is only promised on paper. A lot of people thought Friday was the flush. They thought the worst had already happened. They saw the bloodbath, they saw the panic, and they assumed the market had finally exhausted all the forced selling it could throw at traders. That assumption was wrong. The selling did not burn out. It multiplied. Margin calls kept rolling. Liquidation kept feeding more liquidation. Accounts kept getting cut down one after another. And by the time people came back hoping to escape, some of them found something even worse than a falling price. They found locked doors, orders rejected, funds halted, platforms freezing, traders staring at plunging screens with no working exit. That is not a normal market. That is a stress event. Here is what happened. The exchanges raised margins into weakness and then kept raising them again and again until the leverage broke. In futures, you do not pay for the full position up front. You post a fraction of the value. That margin is what keeps your trade alive. If the exchange decides overnight that the required margin is going higher, you must produce fresh cash immediately. Not tomorrow, not after the weekend, not after you move money around. Immediately. If you cannot, your position is sold out at the market, whatever the price happens to be. And when this is happening to thousands of people at the same time, the market does not give you a graceful exit. It gives you the ugliest price on the screen. One margin hike hurts. 2 margin hikes start draining people. But when the hikes keep coming, when they arrive back to back, when traders barely catch their breath before the next one lands, it stops looking like policy and starts looking like extermination. That is the pattern here. Week after week, more pressure, more capital demanded, more oxygen removed from the long side. Then the system changed again, turning margins into a percentage-based trap so that rising prices themselves automatically demanded more cash from anyone still holding on. Think about how deadly that is. Even if your thesis is right, even if the metal is moving in your direction, the trade can still kill you. Because the higher it goes, the more collateral the exchange demands. The noose tightens as the price rises, and once the cascade starts, the whole structure turns against you. That is why this drop feels unnatural, because it is. Gold and silver did not simply wake up one morning and decide to forget their supply problems, their industrial demand, their geopolitical value, and their physical scarcity. The paper side was hit with a weapon, and that weapon was margin policy. Forced selling creates price damage that has nothing to do with genuine supply and demand. It creates a vacuum. It punishes anyone using leverage. It drives prices lower, which then triggers fresh margin calls for other traders who were never even close to trouble before the first wave started. That is how a spiral becomes self-feeding. That is how a correction mutates into a destruction cycle. And then came the detail that should make everyone pause. On the same day the pressure intensified in the United States, China moved as well. Different countries, different politics, different strategic agendas, constant disagreement on trade, sanctions, technology, and currency policy. Yet suddenly, on metals margins, both sides moved in the same direction at the same time. That is not the kind of coincidence you shrug off. That is the kind of coincidence that makes you ask a more uncomfortable question. What are they both trying to prevent? I think the answer sits inside the physical market. Because the real threat here is not just a price move. The real threat is delivery. The real threat is what happens when too many people stop playing the paper game and start asking for metal. The futures market survives on the assumption that most participants will settle in cash, roll their contracts, or close before delivery. That works fine until confidence cracks. But once physical demand accelerates, once the vault begins draining, once institutions decide they would rather own bars than paper promises, the leverage inside the system starts looking terrifying. Look at the imbalance. There are mountains of paper claims stacked on a much smaller base of real metal. That structure can survive only as long as very few people demand the real thing at the same time. But now metal is leaving the vaults in size. Not small retail orders, not hobby buyers, serious withdrawals, the kind that require transport, security, scheduling, logistics, warehousing. That means institutions. That means industrial buyers. That means money that is not guessing, money that is acting. And when that kind of buyer starts removing silver from the exchange while the paper market is being smashed lower, you are no longer looking at one story. You are looking at two completely different realities trading side by side. That is where the most important clue appears. The paper price in New York has been collapsing. The physical price in Shanghai has not mirrored that collapse. The gap between the two is enormous. Same metal, same planet, same week, completely different price. That should not happen in a healthy, efficient market. If silver were truly worth the lower paper price, physical buyers would not keep paying dramatically more to secure actual metal. They would step back. They would wait. But that is not what is happening. Physical buyers are still paying up. That means the physical market is voting against the paper market. It is saying the screen price is not the true price of scarcity, and the gap has not vanished. That matters, because if this were an honest collapse driven by demand destruction or some sudden glut of supply, physical and paper would fall together. They are not. Paper is getting hit. Physical is staying firm relative to it. That divergence is a giant warning light. It tells you somebody is forcing price in one arena, while the other arena is still reflecting actual need and actual scarcity. Now ask yourself, who benefits most from a violent paper smash? The answer is not the ordinary trader who was long because he believed the supply deficit story. It is the short side. It is the institutions with massive exposure that profit when the metal gets crushed fast, especially if the crushing is violent enough to force long holders out before they can reach delivery. That does not require a conspiracy fantasy. It only requires you to notice incentives. The participants with the biggest short books benefit the most from margin-driven liquidation. The exchange policies that intensify liquidation hit the same side that threatens those short books. You do not need to invent motives. The structure speaks for itself. Then layer in the timing. Negative headlines, policy rumors, stories that hit at the perfect moment to spook algorithms and retail participants alike. Corrections arriving only after the damage is already done. Hawkish signals landing into a fragile setup. Unusual bets placed just before the move. None of those pieces alone prove everything, but stacked together, they sketch a pattern that is impossible to ignore. Pressure was building. The market was vulnerable. Then the right sparks arrived exactly when forced selling could do maximum damage. And the damage has been brutal. Leveraged silver products got demolished. Funds saw historic single-session losses. Traders trying to de-risk reported errors, delays, rejected orders, frozen interfaces, customer service black holes. Imagine watching your position collapse while the platform will not let you act. Imagine trying again and again to close the trade only to get nothing. Not a fill, not a clean error, just paralysis. That is what some people faced, and after the damage was done, margin pressure increased again. Crash, lock, raise. That sequence is devastating by design because it strips away both capital and control. But here is the part that makes this whole event even harder to accept as a genuine fundamental reset. The underlying physical story did not disappear. Silver has been running structural deficits for years. Industrial demand has not vanished. Solar has not vanished. Electrification has not vanished. High-end electronics have not vanished. AI infrastructure has not vanished. Mine growth has not suddenly exploded. And on top of that, export controls and strategic restrictions have tightened in parts of the global refining chain. In other words, the long-term physical case did not implode at the exact same moment the paper market went into liquidation. Only the leveraged holders imploded. That is why this does not look like a clean repricing. It looks like a transfer. In every panic, people say wealth was destroyed. That is not usually the full truth. Much of the time, wealth is transferred from weak hands to stronger hands, from forced sellers to patient buyers, from traders who must act now to institutions that can wait. While retail panic spreads, trucks keep showing up. Metal keeps leaving vaults. Premiums in physical hubs stay elevated. Lease rates stay high. Those are not signs of a market drowning in unwanted metal. Those are signs of stress in the real market beneath the paper collapse. And this is where March starts looming over everything. Because the closer delivery gets, the more dangerous the mismatch becomes between what has been promised and what is sitting there, ready to be delivered. If enough contract holders stand for metal, the strain becomes visible. That is what the exchange cannot afford. It cannot afford a moment where the market collectively focuses on the difference between claims and bars. So the easiest way to reduce that risk is obvious. Crush sentiment, force liquidation, drain longs before first notice day. Make the trade so painful and so expensive to hold that fewer participants make it to the delivery window. That strategy can work for a while. In fact, right now it is working. Longs are being wrecked, charts are being shattered, confidence is being broken. But the physical market keeps whispering the same message. The whisper is simple. The paper price is not resolving the scarcity problem. The paper price is trying to delay the reckoning with that problem. So what should people watch next? Not random support levels, not magical numbers pulled out of thin air. Watch the indicators that expose stress between paper and physical. Watch the premium gap between New York paper and Shanghai physical. If that gap keeps widening, paper credibility is eroding further. If it narrows because physical collapses too, then the bearish case gains credibility. But if it narrows because paper races higher to catch physical, the market is telling you the smash could not hold. Watch vault withdrawals. If more metal keeps leaving while price is supposedly collapsing, that means large buyers are treating the lower paper price like a gift. Watch lease rates. When institutions pay unusually high rates to borrow metal, that is not complacency. That is urgency. Watch open interest into delivery. If people are still standing in size after this much pain, then the exchanges have not solved the problem. They have only made participation more expensive. And watch for more halts, more freezes, and more system stress. Healthy markets do not repeatedly lock people out at the moment of maximum pressure. Distressed systems do. There is another reason this story matters beyond charts and contracts. This kind of event destroys more than trading accounts. It hits businesses, it hits dealers, it hits funds, it hits supply chains. It hits entire trading communities that built their lives around metals. Some firms do not survive the volatility. Some funds stop redemptions because they cannot meet demands cleanly. Some merchants get trapped between futures prices, client expectations, and physical shortages. That is how a paper crash ripples outward into the real economy. Now step back and look at the picture as a whole. Years of physical deficit, persistent industrial demand, tight refining routes, vault depletion, elevated lease rates, strong physical premiums. Yet the headline price is in free fall because margin policy and forced liquidation are dominating the paper arena. That combination is not normal, it is unstable. It can continue longer than trapped traders can survive, but it cannot continue forever without some form of reconciliation. And that is the key point. At some stage, paper and physical have to meet again. Either physical finally breaks and proves the paper move was real, or paper rebounds toward the reality implied by what buyers are actually paying for metal. One of those worlds is lying. They cannot both be true for long. This is why survival matters more than prediction. The people who make it through events like this are not always the ones with the most dramatic thesis. They are the ones who control exposure, avoid forced decisions, and stay alive long enough to benefit when the fog lifts. Being right too early with too much leverage is one of the fastest ways to get financially erased. Plenty of traders have learned that the brutal way. They saw the shortage, they saw the vault drain, they saw the divergence, and they still got wiped out because the margin system reached them before the physical truth could bail them out. So ask yourself the hard question. Is your position built to survive chaos or only built to profit from being correct? Those are not the same thing. In a market like this, they are opposites. If you are one margin call away from liquidation, if one more exchange rule change can take you out, if one locked platform can turn a manageable loss into a catastrophic one, then your thesis does not matter. The market will not care that you understood the big picture. It will simply remove you before the picture resolves. That is the real lesson of this bloodbath. Not just that gold and silver are being smashed, not just that margin hikes can become weapons, not just that paper and physical are flashing radically different signals. The real lesson is that markets under stress stop rewarding people for being merely intelligent. They reward people for being durable. And still, despite all this damage, the physical signal refuses to die. The premium gap is still there. The vault drain is still there. The lease stress is still there. The demand for actual metal is still there. Those facts are why this story is not over. They are why the sell-off feels like suppression rather than resolution. They are why so many large players appear to be taking metal instead of running from it. That does not mean the reversal has to happen tomorrow. It does not mean the pain is finished. It does not mean the paper market cannot be pushed even harder in the short term. It means only this. A market can bully price lower for a time, but it cannot permanently bully away a shortage. Paper claims can be expanded. Real metal cannot be printed. That truth sits underneath every panic, every squeeze, every crash, and every recovery in this market. So keep your eyes on the real signals. Watch the premium, watch the vaults, watch lease rates, watch delivery pressure, watch system strain. Those are the clues that matter now, not the noise, not the headlines, not the false confidence of people pretending they know the exact bottom. Nobody knows the exact bottom in a forced liquidation spiral, but plenty of people can recognize when a market is breaking in ways that have nothing to do with honest supply and demand. And one final thing, do not let the violence of this move trick you into thinking everyone is seeing the same market. They are not. One crowd is staring at red candles and panic selling paper. Another crowd is quietly moving metal, paying premiums, borrowing at elevated rates, and preparing for delivery. One crowd sees collapse, the other sees opportunity. That split is the whole story. So tell me this. Do you think this is a real repricing of gold and silver, or a deliberate flush before the delivery window gets dangerous? And if paper keeps trading miles below physical, who do you think eventually has to blink? If you are getting value from this breakdown, subscribe and stay close, because the next phase of this story will not be decided by headlines. It will be decided by who controls the metal when the paper promises finally meet reality.